So I've got a question that came in from Marco. And Marco says, MU, AMD, and NVIDIA are falling. Best strategy suggested for has such stocks in the portfolio with unrealized losses. Thanks. Okay, so we've seen some big moves recently. MU, of course, they had earnings today. If I'm not mistaken, let's take a look. Oh, it was yesterday. I apologize. It was yesterday after the market closed. So today's movement down on MU, Marco, was related to the disappointment in the earnings and the, I believe, potential that they're still going to be struggling with some supply issues, I believe, or some tech issues also. Tech also got hurt. You also mentioned AMD and NVIDIA. I'm going to go ahead and take a look at those in just a moment. But let's stick with MU. Now, I'm just going to take a look here. Sorry about that. Let's go to big charts. And a comment just came in. Okay, there we go. Good. The MU has been on a decline recently. And this is just a 3-month chart. Let's go back 6 months. Okay, Marco? And why I want to go back 6 months is this is typically what we've seen. We had some lulls here. If we go back year to date, you'd see the big decline in January. We're just looking at, it wasn't that big, actually. It was pretty big in January. Went down from about 95 to about 75. Yeah, so that's over 20% there. It rebounded nicely. And then it started to go through these fluctuations in this time period. So let's say we got in after the second route, in a sense. Not really at the end of the second route, but sort of a little bit after that when we thought things were maybe changing. What do I mean by that? And, oh, there it changed. I'm sorry, folks. The pen icon changed on me. There we go. So I don't know when Marco got in, but let's say after this second route here, it started to recover. We were feeling pretty good. We got into this position here, let's call it around $72 per share. Okay, and the stock's now trading right at about 54. So we've got a significant $18 loss there on that position. We're probably, again, looking at something along the lines of a 20 to 24% decline. It was even heading down before the earnings, and then it got that extra kick from the earnings. Why do I mention this? What are some of the strategies that investors would look to use to hedge a long stock position? Well, the obvious one and the easiest one that most investors would consider is just a covered call. I'm going to sell calls continually, Marco, against the position, just at or slightly out of the money. I want to try to lower my cost basis in those situations. And so as I generate income over time, and hopefully I don't have to roll it, but with these movements, there have been a lot of investors who've had to roll those covered calls up, Marco, as the stock reached the price. And then what they would have to do, of course, now is buy that back at a higher price and sell further out in time. And yeah, if there's another pullback in that case again, Marco, then they can maybe buy that back cheaply and sell a lower strike call, and then oops, it runs back up again. This has been the danger of naked put investors. I should say this is the danger that has faced naked put investors, covered call investors. Anything that gives you a capped gain to the upside while still taking on 95, 97% of the risk of owning the stock outright without protection in place. So you're in a situation now. What is the best strategy suggested for those who have stocks in a portfolio with unrealized losses? We talked about this a little bit last week in the sense that one I referenced is 2 weeks ago. My apologies, Marco, when you had asked one of the questions on it. Should I enter a married put on a position that is down now? Well, I'm going to take a look real quick. Let's go to the portfolios. We're going to use that value that I had put in. We're just going to use MU as the example here. And let's just put in 100 shares. I think it was maybe back in March sometime. The date is irrelevant when I was looking at it. Just put in March 24th, excuse me. And we said we got in after that second decline and it started to look favorable again, and we got into about 72. We're not going in the high price at 95 on January 3rd, so on and so forth. We'll just use the 72 price here. And as you can see, yeah, it's down 25.5% on the position. Where are we now? What can we do to adjust this position? Well, you could continue to sell calls against it, or try to sell calls against it, Marco, to try to lower this cost basis. Are you going to be able to make up 18 points with a reasonable, slightly out of the money call premium. Not anytime soon. It is a long haul management of this position that you're looking to do. And that's going to be a little bit rough. I'm not saying, okay, I want to say this. I'm not going to say exit the position. That's a choice you have to make. You're asking me, what are the best strategies to use now that these stocks have declined, which means you're planning on staying in them because you're hoping to make back this 25.5% loss on this particular stock. You don't want to admit the loss in it. Sometimes you want to get out of the position that's not going in your direction and find a trade that is going in the direction you want for either the option strategy you want or just the general stock holding itself in general. But let's go to the option chain. And let's go reasonable time frame. Let's just go to calls. I want to go reasonable time frame out in time. 21 days, 15. That's too close, but let's just see what the average is. 4 weeks out in time, 28 days for slightly out of the money call. Well, it's not that bad. So here's $1, $1.30. Here's $1.05 at the 58 strike. That's about 10% out of the money. And 5 points away, and a little bit less, 435 out of the money, I guess. So it's under 10% out of the money, and that's shown right there as well. It's 8.1%. The 10% exactly out of the money here is only 81 cents. Why I'm saying that is if you assume that you can go 7 to 8% out of the money, Marco, every 28 days and collect $1 in premium, it's still going to take you a year and a half to get back to break even. Now, your hope is that the stock comes back up in price. But what we're looking at is the second to worst case scenario. If I'm trying to repair with covered calls in this scenario, where I'm down 25.5%, going 4 weeks out in time, getting $1 premium, 8% out of the money, if the stock just stays right at 53, 54, and I can still get that premium, 7 to 8% out of the money, that's still a year and a half to get back the 18 points we're down from 72 to 54. Now, are there other alternatives? Well, you could sell closer and say, oh, this will only get me 9 months to get to break even. But what you can't risk with these types of stocks that you're mentioning is sort of the wild swings that we've seen before. Because even here, there's risk of selling the 59 call. If the stock suddenly goes up to 65 in the next 10 days, you've got to catch that quickly and try to roll that call back up in price. And that's going to cost you more money and add to the cost basis of the position. So it's an approach, but analyze what the reasonable out of the money call premium is for what you think is going to happen. 6, 7, 8% of the money because we have a higher volatility here. Volatility is going to fluctuate and volatility is going to change. This has a higher volatility right now because of the event, and it's not really that high at all, honestly. 0.44, 0.43. It's not that bad. But because of the events today and the earnings, it was probably 0.6 or 0.7. These options were probably 0.6 or 0.7 yesterday. Let's just take a look as we were heading into the earnings event for the yesterday afternoon. The close of business yesterday, 0.57, 0.58, close to 0.6. So not as high as I thought they would be, but still, that's 29 days out. The nearer term ones, I'm sorry, one of the ones most affected, 1.7, 1.8, that makes a lot of sense, but you weren't probably doing one-day trades. Okay, sorry about that. So let's go back to the current. And let's go back to our 28 days out in time. I'm just using 1 month as the example. Get a good premium in this case. I'm not saying that this is a best approach. I'm going to list a couple of approaches, Marco, but you've got to consider which one. What does, if I sold this 58 call for the July 29th expiration, what does this not do? This doesn't do anything to hedge against further downside on this position. I don't know what the bottom is. I'm going to be honest with you. I don't know how affected tech is going to continue to be, semiconductors, things of that nature, chip makers and so forth, with continued supply chain issues that seem to be lightening up by some people's comments. But again, that's all still there. And it's all still inflationary prices and everything along those lines. So let's take a look here. Just if we had MU at 72, and we sold that 28-day out call with our 58 strike to get about a $3, $4 in premium, Marco? Okay, so we have a 25.5% unrealized loss. We're generating about 6% in premium. Now, we're not generating 6% in premium exactly. It's about 2.5%, 3%. The max return is a loss of 18.3%, which is 7.2% below, but that's assuming the stock's trading at 58. So you'll get that $4.35 back plus the $5 premium. But if the stock suddenly has a run, as we mentioned, and it goes up to 65, 66, or to 70, now we're going to have to pay more money to move this call and go further out in time. What, again, does this not do? It doesn't do anything to address this area. You still have the potential, although you've lowered your cost basis on the position from 72 down to 70.95. Your plan would be to have to do this continuously, as we mentioned, to knock the cost basis down with the hope that there's still going to be some growth in the stock, a rebound of some kind of recovery, but we're still in a volatile market where there's going to be a lot of whipsaw events, and that, of course, could get you into trouble. I never advocate averaging down in price. If I had the capital, I could, of course, simply buy another 100 shares of Micron at 54, and that would take our cost basis down from where we originally were down to about 62 or 63, right? I'm just using 54 as an example there. Yeah, so yeah, it's exactly 63. So if you average down with another 100 shares and get to 63, now you're only 10 points down, and it might only take you, okay, well, let's call it 9 points down. It'll only take you 9 months to get back to break even with this premium. But now you'd have 200 shares at 63 for a cost basis of 12,300, and you'd still have the similar risk graph here, Marco, in the downside. That hasn't been addressed yet. One thing I always recommend in these situations, before you just decide to sell the out-of-the-money calls or sell a 6-month out-of-the-money call to get half of the premium back, but you're not going to see the time decay on that 6-month out option until you get closer to it. So even though the stock's staying, let's say you went up to 65 and got $4 in premium for January, you're not going to see a lot of time decay on that call until you start getting into October or November, where it makes sense to buy it back and then sell another one to get another $4 that's now 6 months further out in time. So it's always a good idea to check the stock repair tool first. And we can just put in the shares here. What is my cost per share? It was 72, and we have just 100 shares in that situation. Now what the stock, I was afraid of that. You won't always see repairs in this case. So what this tool tried to do, of course, is to build a ratio call spread, buying an at or slightly in the money call and selling 2 higher strike calls to try to generate a net credit. You see here, there are a lot of repairs that generated a net credit out to August and out to September, but it doesn't get us back to break even. That's why the trade details and the break even line are still NA. In this case, if I average down, bought another 100 shares around 54, brought my cost basis down to 63. Dangerous because it doesn't address the downside. We do see some repairs out to October. Let's take a look. It is far away. All right, so we're in July here, so we just started July. So we've all of July, August, September, and October. It's essentially 4 months away. But in this example, what we do is sell 2 57.5 calls for October at 390. So we take in 780. We're going to buy a lower strike call at 52.50 for 645. This does give us a net credit of $1.35 on the position, which would lower our cost basis down to 61.65. But our break even is at 57.08. How is that possible with just generating $1.35 and lowering the cost basis down to 61.65? How do we get to break even at just 57.08? That is at October expiration, still 4 months away. Well, the concept, how it works, is I'm essentially entering a bull call debit spread. I'm buying 152.50 and selling 157.5. 390 by 645. So essentially it's a net debit on a 5-point spread of about $3.50. But then we're selling that other call for 390. So that gives us the net credit. So essentially I have a covered call with the 100 shares in one of the two calls, and then the bull call debit spread with the remaining. So no margin is required on this position. You would need to be approved to trade spread positions, probably need level 3 trading in order to do the stock repair, depending on your broker and how they handle it. But nothing's naked in this case, even though you're selling two. You've covered by the stock, and then you've got the bull call debit spread. And what happens in a bull call debit spread? Well, if the stock is trading at or above our short call strike price at 57.50, this bull call debit spread we entered, we essentially buy shares of stock at 52.50 and sell them at 57.5, so we get 5 points back from that portion of the spread. Now we're getting assigned at 57.50, and we took in that extra $1.35 of net credit that we saw. So we get 5 plus 57.50 at assignment, which puts us at 62.50, plus the 135. It's a small return, as you can see, of only 85 cents or 1.4%, but we only needed the stock to go back up to 57.50. In reality, 57.08 just to break even. What happens in the stock repair at 57.08? These two calls expire worthless. Our stock's valued at 57.08, and this option that we bought, the 52.50, has about $4.50 of value, intrinsic value, Marco. So we sell to close that position, and we're back at break even with the stock only needing to go back to 57.08 instead of to 63. But when you don't see a stock repair available, you might have to evaluate averaging down. Now, if I average down and went to 63, and I gave myself that out of the money room every 30 days at the 57.5 or the 58 strike, remember 7 to 8% out of the money for a 28-day period, hoping the stock doesn't rise too much above that in that time frame, we were looking at $1 premium. So even if I average down to 63, in this case, with the stock trading at 53 to make back up that 10 points, we still need about 9 or 10 months of selling the out of the money call. The stock repair after averaging down could potentially get us back to break even in 4 months to October from July. So it's not a bad play in that case to do that. Now, what does this not do? This also does not address the downside of the position. The stock could continue to fall in this scenario, and you could still compound your losses. And we also had to, I'm sorry, that would have been 200 shares. I'm sorry, at 63 with selling 4 calls. I'm sorry, and buying 2. I did 100. But if I average down, we'd have 200 shares. You understand that as well, okay? I'm sorry, Chuck said, don't forget you can sell 2 calls. Yes, that's what we're looking at here. If we sold this here, it'd be 2-to-1 ratio. So we've got the bull call debit spread and the covered call, Chuck, in that case, the 2-to-1 ratio spread there. And if the stock moves up, I'm sorry, in this case, I think you were talking about the when we got assigned in that case at 57.50. So we had the bull call spread and we had the covered call. But if I wanted to hold on the position longer, if I'm reaching October and the stock's trading up here and I still want to have some upside, I could just roll this one covered call, leave the bull call debit spread there to get the max profit, and continue just to trade this as a covered call position if I'm expecting further all sides. Okay? Yes, Marco. This is sort of the ideas that you run into with these positions, these repairs. Marco's comment is, so also with a stock repair, I'm still limiting the upside, and as you said, not addressing the downside. That is correct. That is absolutely correct. Could I add a put to this position? Not a good one. Okay, and what I mean by that is that the repair is working because we got $1.35 net credit plus the 5 points we hopefully get back with the bull call debit spread position. If I negate that 135 premium taken in, it won't get me back to break even. The lowest put I could buy is the 40 strike put with still keeping any value of the net credit, and it's essentially a wash at this point. So if I add this to address the downside, we're only buying 1. Now let's just put it at 132. Yeah, see, it negates the credit, which also negates the repairs. But even if the stock goes back up to that where we were at 57.50, you're only at a loss of 0.7%. But you still have the potential for a 36.5% loss. And that's because our new cost basis is 63. The insurance doesn't kick in till 40. If I bought a higher strike put, Marco, that would just take out more of the credit, and here we'd still be at maybe a 20 to 25% loss. Let's go right at the money. Not what I would ever do. This isn't don't do in this case. And let's just use the 52.50. It's close enough to at the money in our example here for this scenario. So we've got a down stock at 63, tried the stock repair after averaging down, and then we're going to buy another put right at the money. And now if the stock hits 57.50, we're still at a 6.2% loss. But an interesting thing here is the max we can lose is 21.2. Why is that interesting? Well, we average down in this example. So we have a new cost base of 63, not the 72 we have right now. Right now where we are at a 72 price for our stock, pre-averaging down, we're at an unrealized 25.5% loss. Averaging down, adding the, you essentially created a collar is what you did here, but averaging down and then doing the stock repair, you might only lose 6.2% if the stock's above 57.5, but you could still lose 21.2%. There's no fail-safe, Marco. And most of the repairs that you're looking at, in this case, Marco, are going to have the capped gain. How do we repair a stock scenario? How do we lower the cost basis of our stock and get it closer to break even? Well, it's going to be by a combination of selling premium, or if you're on the outside, I'm not the outside, but if you're sort of going out of the box, trying to maybe buy call options when you think the stock's in an uptrend and buying put options just to profit here and there, which is a hard game to play because you've got to get the timing right. You could add to the losses easily in uncertain markets by saying, okay, MU had a big dip today because of the earnings that came out this morning or last night, and we're down near the bottom of where we've been for a long time. I think it's got a rebound here, so I'm going to buy some 55 calls for July. Well, if you're wrong and it stagnates and it goes down to 52 and 51 over the next 3 weeks, that call is losing money now. You have to add that into the loss you're taking on the total position. Unless you get the timing exactly right, trying to go up and down with those positions, it's going to be very difficult. To leave the upside open, what is another idea, Marco? Well, of course, you could go ahead and add an extra call. This would essentially create a butterfly position. We're going to use a broken wing. So we've got a 5-point break here. We're going to go 10 points to 67.50, which negates the net credit we received from the repair to begin with. And it still is out to October. We're keeping it even. What would this scenario look like? Well, we're essentially adding a broken wing butterfly that gives you this flat point, which is a small loss of $47 if the stock's between 57.50 and 67.50 at expiration, but then you leave the upside open. But again, we can't address the downside because that's going to add to the cost and take away from the position. Per our discussion 2 weeks ago about should you add a put to a declining stock, following sort of the married put approach that we advocate in the blueprint for longer term protection, trying to keep the risks to single digits. We'll get to that in a moment. But also in that case, what can we look to do with this scenario? Could we apply it now? And that video we discussed from 2 weeks ago, the married put discussion searching for ETFs and the searching for the ETFs in that case, and should I add a married put position? Sorry about that. Should I add the married put position to the existing trade now, whether we've averaged down or not? Well, we can say that, but let's take a look here. Let's go back to our original price of 72. We know we've got a 25% loss on the position. Let's go further out as I would with the married put approach. 150, 200 days. Let's just go to January. And I'd still be buying 1 or 2 strikes in the money. I'm going to try the 57.50 put here, 915 and 930. So it's expensive. We know we have a 25.5% unrealized loss on our example price of $72 per share. Let's put this at 925. There we go. So by adding this put, we're really only adding a potential risk of 3.7% if the stock's trading anywhere below 57.50, of course, in the next 200 days. And at the end of 200 days, if the stock's still trading below 57.50, we take a loss of 29.2%. But if it falls to 30, if it falls to 35, if it falls to 40, we can't lose more than that 29.2%. But what are we doing? We're locking in the unrealized loss of 25.5% we already have, and we're adding that additional 3.7% that's the time value of this put option at 925. And that's for the 57.50 strike, probably how I'd set up a married put on MU if I was opening a new position today. Now, of course, you could average down as well. We could do 200, and we saw if we bought it at 54, that would take us down to 63, and then we would buy 2 puts at 925. So now you've got 14,000 invested in the position. After averaging down, the maximum loss you can take is 20.4%. That's the worst case scenario. If you do nothing else between now and January expiration, the stock is below 57.50. And of course, you didn't accept any dividends or do other adjustments. That's when you would realize the full 20.4% loss. But by averaging down and adding the put, yeah, you double the potential monetary loss you could take. But you're in a better position now with unlimited upside. But yes, your break even is still at 72.25. Okay. And that's because of the average down stock price plus the price of the put. But that break even again, Marco, is only at January expiration in this case, if you hold it all the way through. If the stock does recover, let's say you get back up to $58 per share in August, next month. Let's just say on August 2nd or August 3rd, somewhere in that time frame. Now you're still at a loss, all right? So you've still got a loss in the position, even though it's moving back up to your break-even point of 63. Your put's declining, but you're still at about half, a little bit more than half, the maximum loss. So you're still only at a 10% loss, and you'd be planning on doing those positions. You'd be planning on doing adjustments. But just like we saw, Marco, with doing the covered call now against our full price of 72, or even selling the 58 strike call if we average down and the stock was at 63. If I sell a call now below the cost basis, which I probably have to because the stock's at 54, but I still want to sell it. Let's sell that 58 call again, that $1 premium again. And of course, we average down, so now we're back into the 2 roads in this situation, the 2 puts, 2 calls. At 28 days, the best case scenario is we make a loss, of 9.5%, but we reduce this. You'd still be trying to sell premium against it or do the other income methods in the blueprint, maybe income method number 6, the bear call spread, to leave the upside open in those scenarios. That's what you might be looking to do in that case. Now, that addresses the downside. It controls it, but you have to put more money into each position. NVIDIA, AMD, MU. It's going to be very expensive to average those down. Then look to evaluate the good put option that you would use if you were opening a new married put today, following the rules in the blueprint, and then knowing that you're going to be continuously trying to make adjustments. Now, as the stock moves up, you're going to be able to manipulate the put as well, in addition to selling premium. There is no one guaranteed direct way, with all of the tricks we have up our sleeves and all the different combinations you can use, Marco, that's going to help you get back to break even in a short time frame of these positions that are underwater, while still giving you protection to not risk more if it continues to move against you. There's a give and take with everything, and options aren't a universal answer for something that has had a large decline. You saw how you could help yourself get back to break even. Another comment came in and says, well, instead of averaging down, could you do better? I was getting to this. Could you do better by still selling the calls against the original position? I think Jim said, yeah, selling calls against the original position, Jim said, and then selling an out of the money put. Well, yes and no. So let's go back to just our original position, 100 shares of MU at 72. We were looking at the July 29th, 28 day out, 58 call for about $1.05. And let's try to double that. Let's go with, why not? Let's go with the 50 strike put, which we could get about $1.40 for, an extra premium each month. And the idea behind this is typically what we refer to as a covered combination, owning stock, selling a call against it, and then selling additionally a cash secured put on the position. The advantage of what Jim is talking about here is that instead of buying another 100 shares at 53.65, I'm just going to put up another. Oh, I bought that. I am so sorry. That's why that didn't look right. I'm sorry. There we go. That's much better. Instead of buying another 100 shares at 53 and putting up 5,300, I'm only going to cover the monetary requirement of the naked put, the cash secured amount of $5,000. I get an additional 140 against it. The best case scenario, 28 days from now, on July 29th, is if the stock is right at 58, we're only down 9.7% on our position. We take in $2.45 of premium to help with that loss that we have. And if the stock moves back up to 58, we've gained another $4.35 back plus the $2.45 premium. We're looking pretty good, but we do have to put up another $5,000. Now, this does not address the downside, and in fact, it worsens, similar to averaging down. Why? Because owning the stock does not cover the cash secured naked put obligation here at 50. That's why we had to put up that additional $5,000 to cover this requirement. If the stock starts to fall below 50, I'm now losing on this cash secured put where I may be forced to buy shares of stock at 50, and I'm losing on my already unrealized loss long stock covered call position. So I'm losing on two different structures now. However, the concept is if you pick the strikes right and you get the good premium, if the stock stays within this range, each month now you're making closer to $2.30 or $2.40 instead of that 105 premium. And with a current loss of 18, this still might only get you 9 right cycles, maybe even 8 right cycles, assuming a gradual move up on the stock position to get you back to break even. But we've doubled the potential loss here because we can lose on what is now a covered call working as a repair and the cash secured naked put. But Jim is right. It is another way to do it. We call it the covered combination as a general strategy open from the beginning in this case. So that is something to consider, but comes with a cost. Doesn't address the downside. And buying a cheap put, as we saw earlier with the stock repair, Marco, that's going to put you in a different situation where this risk would be higher based on the time value of the put that you purchased and would negate further downside losses into this realm. That's a bankruptcy. If it goes to zero, you'd be risking $11,954 now in this position. And you'd continue to do this to get the oomph in premium, for lack of a better term, double the premium, double your pleasure, double your fun here, but you've got to put up the margin requirement. Now, as the stock moves up, if it doesn't breach your short call, you don't have to necessarily write the 50 put. You could then maybe write the 52.50 and keep bracketing the stock up in that direction. But it doesn't address the downside. In fact, it nearly doubles the downside risk in this situation because of the premium. Now, this is not average down. This is just the straight initial cost of $7,200, but that the covered combination, approach, Marco, is another concept. So you want to step back, Marco. You want to take a break. and what I mean by that is you want to evaluate and think for yourself, what are some of the ways we could fix the position? Number one, you could just sell covered calls against it, knowing that you want to stay out of the money because you can't risk getting assigned on the position, right? You don't want to get assigned and locked into the loss. And if the stock recovers faster than you're expecting, you may have to roll that up faster, and it might cost you $4 or $5, which is now adding to the cost basis. But thankfully, the stock's moving in your desired direction, but you're still adding to the cost basis in that situation. Number two, good approach is to evaluate the stock repair position. Using the tools and PowerOptions, just put in your cost basis and your number of shares and see if a stock repair is available, which might help you get back to break even faster. In our example, we didn't see one. One didn't come through. So then if you don't see a stock repair, your choice is maybe I just do covered calls for now, thinking the stock's going to stabilize or move back up to get the cost basis lower and see if this opportunity comes later. Or if none are available, evaluate your averaging down. It's very risky. We don't like advocating to do that in those situations. But you could do the average down first, and then look at your covered call, how many right cycles it would take you to get back to break even, assuming the stock stayed the same, knowing you haven't addressed the downside or stock repair. The number 3 approach, I did kind of like it. If you do this, if you don't like the covered call because it's too many right cycles, you can't find a stock repair. If you consider averaging down to do the stock repair, I would consider that put aspect that we showed. Maybe buying that January or following the rules that we follow in radioactive trading, go at least 5 or 6 months out of time, buying a slightly in the money put to control risk, average down, buy the put, and then treat it as a married put position from that point on, knowing you still may have had a maximum loss of 20%, or the married put approach with the stock repair after averaging down in price is another way to go. Now, it's out of order. I should have mentioned this as number 2 or number 3. If you don't see the covered call, you don't like the right cycles it would take you just with the covered call without averaging down, Marco, you don't see any good stock repairs to come up, maybe before averaging down, consider this covered combination approach. Again, what does it not do that you were hoping for and looking for? The covered combo approach does not leave the upside open. You're admitting that you're going to have to do this for a few months to get yourself back to break even, but it now doubles the risk in that case because you could lose on the cash secured naked put and the covered call. But if you don't see good opportunities for the covered calls and the right cycles are 18, 19, 20, 25 months, you don't see an opportunity for stock repair before considering averaging down, take a look at that covered combination and see if it matches your risk tolerance versus the increased premium.